Hello, investors. This is Don Vandenbord, Portfolio Manager with Revere Asset Management, and welcome to the 12th Lunch and Learn. This series started all the way back in August 2019 to educate you on how to successfully navigate the markets. We're very big on education here at Revere. We want our clients to be educated on what's going on with the markets. We're the most transparent registered investment advisor that you will find between all of the content that we put out and the educational material. And we want to empower people to do this on their own. If you're not interested in doing it on your own, we'll certainly assist you and do it for you. And all you got to do is contact us. Our website, revereasset.com. Let me bring that up very quickly here. And if you want to ever speak with Dan, Tim, or myself, all you got to do is hit us up on email, Dan, Tim, or Don at revereasset.com. Available from the main page of our website. Here's the Daily Market Insight. These are videos that we produce 5 nights a week. We also produce weekend podcasts. And this, of course, is the Lunch and Learn webinar. Feel free to reach out anytime. You can also, all of these webinars, all the Lunch and Learns are archived out on our YouTube channel. Just go to YouTube, type in Revere Asset in the search bar, and you'll see everything that we've put out there. Reminder, this is for educational purposes only. We're not asking you to buy or sell any securities, ETFs, funds, anything like that. Do your own research. We're presenting how we do things in-house to give you the confidence to do it on your own. Today's topic, a complete investment plan. I'm going to review the key concepts from all prior Lunch and Learn webinars, throw a few new nuggets in, and always want to remind you why we do these. It's not how much you make, it's how much you keep. And at the end, I'll take Q&A and do charts on request. So let's get started. First of all, main 5 topics that I'm going to talk about today. Why do we not just do a 60% stock, 40% bond, buy and hold portfolio and just ignore what's going on in the markets? I'm going to touch on that. Talk about the overarching strategy, which is my 13 rules for investing success. Then we're going to talk about some tactics for applying that strategy, including a daily checklist and some things that need to be done either in the morning, in the evening, or during market hours. And then one of the most successful Lunch and Learns that we did was on gaps. And gaps are all about identifying a change in character in a stock and how it can be set up for a big market run. And then probably the second most successful one is an analysis of the past 11 bear markets. I'm going to present some stats on why you want to get the heck out of the way when the market turns decidedly south. And as we're always preaching, the 200-day moving average continues to play a key role in that strategy. So let's get started. Why not just do a 60-40 buy and hold? Well, what you're looking at is a monthly chart of the S&P 500 going all the way back to 1994. And what you see here is decidedly an uptrend. Also, what you see is very clear. 2 absolutely periods in time that could have been decimating to your portfolio if you were not able to navigate them and get out of the way. These are the kind of times that try men's investing souls or women's investing souls. And if you don't have a plan to get out, it's very possible you get out at the bottom and you're afraid of getting back in because you're afraid of getting hit. We've got firm rules for navigating these. This was, of course, the blow up of the tech bubble back between 2000 and 2002. This was the financial crisis, which was even worse, 2007 to 2009. And you can see a very nice recovery since then with a couple of hiccups along the way. That's why we don't just stick with the 60-40 buy and hold. Now, it's not to say that that's absolutely the wrong process. If people got in down here and they've got nerves of steel and they've been riding it the whole way, you're going to be successful and certainly more financially successful than you were had you not been investing at all. But if you just do 60-40 in the averages, you're going to get average returns. We believe in trying to identify the stock market's biggest winners, history's greatest stocks, because this is where you can really make significant amount of wealth in a 1 to 2 year period. In individual stocks at the right time. I say 1 to 2 years. Some of them just really go on strong runs like that, 1 to 2 years. Some of them you can hold for a decade. Let's take a look at a stock like Amazon. Amazon had blew up all the way back during the tech bubble, got down under $10 a share. Now it's $2,000 a share. These are the type of big leading stocks that we want to identify and get our capital into so that we can take advantage of big runs and really do better than what the averages would give you. So that is clearly one of the reasons why we do what we do here. We're active management, active investors. Again, what we're looking to do is to have our equity curve not have these huge drawdowns like you see in the S&P 500 right here, but more a gentle sloping from the lower left to upper right with just a couple of hiccups along the way. And a lot of the rules that we've developed have allowed us to be successful in taking that approach. So that's why we do what we do. Let me step into the 13 rules for success here. Let me bring this in. A lot of you have seen this before. I'm going to quickly go through it. They're so very important. Start out with never lose big. And again, this gets back to why we want to have rules in place to dodge those big 50% drawdowns, the two of them that I showed on there. But there's more than just two drawdowns. And when I go over the analysis of the past 11 bear markets, going all the way back to 1968, you'll see what we really want to avoid. But in an individual investment, if you lose 5%, all you have to do to break even is get to 5.26% on your next one. If you lose 10%, 11%. If you hold on longer than you should, and again, this 10% is really the worst you want to lose on any individual investment. 25% down, your next investment has to make 33% in order to get back to even. You hold on and lose 50%, you need a double on your next one, and 75%, you need to make 300% on your next investment to get back to even. That's rule one, never lose big. Rule number two, we definitely want to stick with the trend. I provide, every time I do a video, let me find it here. I talk about it's the trend gauge, very plain and simple, and really it's just a simple way of understanding what's going on with the market over 3 time frames. And it looks like this. This is an example of when we were very bearish. If you look now, it's we've been bullish. We've been bullish for a while, going back to October of last year when this uptrend started. And I mentioned 3 different time frames. The short-term moving average follows the 21-day exponential moving average. Intermediate term is the 50-day moving average. Long term is the 200-day moving average. That's really your line in the sand for when you want to get out. And you also need to identify what type of market it is. If you're trending higher, that's the time to be in the strongest stocks that are in the strongest sectors in the market. If you're going sideways, take your foot off the gas a little bit, only buy pullbacks at that point. And if you're in a downtrend, you don't want to be buying breakouts in any way, shape, or form. A lot of people talk about, let's move on to rule 3, diversification. We diversify through sectors. 60-40, if you do that, and you just want to hold on for the long term, that's completely your choice. I don't think you'd be listening to this podcast today if you're going to be satisfied with that. We don't want to diversify into poorly performing assets just for the sake of diversification. Even if you were diversified in stocks and bonds during the financial crisis, a diversified portfolio lost about 50.5%. That's based on the 20 years till retirement Vanguard target allocation portfolio. So at that point, you didn't want to be in stocks. Bonds didn't save you. Bonds certainly performed better than stocks during that time, but we don't want to be diversified into poorly performing assets. Rule 4 is optimizing your watch list. You always need to know what's going on with the market, identify the leading sectors, the leading industry groups, and always keep your list of stocks ready. I provide a 21/21 list, which is leading stocks. I review it at least once a week, updated on Fridays, and that's available always from the daily market insight videos that we do. Rule 5 is about buying. We're screening for the best of the best. We're looking for stocks that we want to buy on technicals and fundamentals, and we're looking for a catalyst that's going to push them higher, something new, either a new product, a new service, new business conditions, new management. But then once we make that purchase, the technicals take over. It doesn't matter what the fundamentals look like. It doesn't matter what your opinion on the stock is if the price isn't supporting it. So if it's poor technically and the market is not working, your stock's not going to work either. That's why we cut all our losses quickly. Rule 6 is about a sell strategy, and you won't hear this from people on Wall Street. And again, we're going to bring the key 200-day moving average into play. Since 1960, 22 of the worst 25 days and 83 of 100 worst days in the S&P 500 occurred when we're under the 200-day moving average. Now, what you'll hear the Wall Street pundits say is that, well, what if you're not in the market and you miss the 10 best days? They never talk about the worst days, which occur when you're primarily when you're below the 200-day moving average. The only time it's okay to have a sell strategy is never. Low risk entry points. This is about putting our process into place by buying the individual stocks. Two key patterns that we look for are high volume breakouts and low volume pullbacks in leaders. Rule 8 is stay out of the dumpster. Cheap stocks are cheap for a reason. Don't catch falling knives. In other words, stick with the leaders. If you can't make money in the leaders, you're not going to be able to make money in the market. Rule 9 is about relative strength. If you're familiar with my videos, I talk about it all the time. Relative strength is how any stock is performing versus other stocks in the market and the overall market. Focus on the ones with leading relative strength, and they will lead you to the best stocks. Rule 10 is about understanding the math. Einstein supposedly called compounding the eighth wonder of the world, and that's another reason why we want to avoid these huge drawdowns. And it's also important to understand that there are 5 outcomes to each trade. You can have a big gain, a small gain, end up near break even, a small loss, or a big loss. Just eliminating big losses in your portfolio, there is nothing from stopping you from selling a stock and buying it back again. It's so critical that big losses, and again, we're going back to rule 1, never lose big. Eliminate big losses from your portfolio and your results will be so much better than they could be if you have a couple of those thrown in every once in a while. Also important, position sizing based on a total percentage of your portfolio and volatility. I'm going to talk about these in detail a little bit more. Rule 11 is about building and managing a portfolio. Again, I said we diversify by sectors, by leading sectors. We also include ETFs in most of our portfolios as something to smooth out the volatility. Rule 12 is about trying to control your emotions and using just the facts. Price is really the only thing that matters. Your opinions don't matter. All that matters is the price and what's going on in the market at the time. And then Rule 13 is about making a commitment to rules 1 through 12. I've trademarked the process called Growtection. It's talk about growing your capital in uptrends, protecting it during sideways markets and downtrends. you get to choose the pain of discipline or the pain of regret. I'm going to choose discipline because they're time-tested rules that have worked very well. So those are the 13 rules. Let's move on to daily tactics. This is things that you want to do on a particular basis. And again, market investing over 3 time frames. I talked about in the 13 rules: short term, intermediate term, and long term, using the 21-day, the 50-day, and the 200-day moving average. Talked about the psychology, how price is so much more important than your emotions. The 21 over 21 list. Again, I talked about it every Friday. Basically, I'm looking for what the short-term leaders are in here, and I want to get my money into them. So it's a watch list diversified by sectors, and I keep 21 of them, and I want them to be 21 over the 21-day exponential moving average. I talked about the 5 outcomes. This is a component of psychology, how we want to eliminate big losses from ever happening in your portfolio. Just commit to that rule. Commit to the rule of not being heavily invested over the when you're under the 200-day moving average in the major markets, and you'll do very well. How are the leaders acting? This is a very key component of what's going on with the market, because when the leaders start to falter, the averages and your balance is going to go down. Entry and exit. Let's talk a little bit about risk management here. We generally take about a 4 to 5% starting position, and how do we calculate that is because we take the size, we set our stop, we calculate our stop, and we don't ever want to lose. For entries, I don't want to lose more than 0.33% of the overall portfolio for anything that I'm buying. So I use some spreadsheets to calculate to tell me what the proper size is going to be. Let me bring this one in so you can see it. Assuming I can track it down here. I must have closed that one, but basically it's a spreadsheet that, oh no, here it is, position sizing. Basically what I'm doing is I want to know how much can I buy to where worst case scenario my stop gets hit. I don't lose more than 0.33% on an individual stock. If I'm buying an ETF, I'll bump that up to 0.5%. But basically this tells me how I can size my position. Another way of calculating your position is to take a 2 ATR exit. Tim is, if you're familiar with Tim's videos, he talks about ATR on his videos all the time, and buying back when you're at the regressing to the mean. He shows 3 ATRs on there. A 2 ATR stop is very sufficient very often, and the position sizes end up being correlated very much. And this is just a way of making sure that your position sizing works and you don't ever blow up a portfolio. Very key risk management is to always know where the 21 and the 50-day moving averages are on anything that you're owning, because you'll see it time and time again, and this is one of Investors Business Daily's key rules. Stocks come down to the 50-day moving average all the time. That is really your maximal, the worst case scenario for where you want to come down. A harsh break of the 50-day on heavy volume is a sell signal. So when you're sizing your entries, the 50-day moving average is definitely something that you need to factor in, because they get visited. It gets visited constantly. Earnings risk is the next thing I want to talk about. When we go into earnings, Tim and I discuss this all the time. What's the proper size of something to take if you're headed into earnings? And really what we do is, Tim helps me out with this. He takes a look at what is the expected move on something that's going into earnings. And we just want a worst case scenario of 2 times the expected move to the downside. And what we're trying to do is to never lose more than 1% of the total overall portfolio. And this spreadsheet gives me the calculation of what my maximum size can be and tells me if I need to cut it. Very rarely do we need to cut this back. One time when it really paid off was back in April of 2019. I had a big Xilinx position that was acting very well. but it told me that if worst case scenario happened and it had a -2 move to the downside, I was going to lose more than 1%. I was going to lose 1.44%. So I cut it back to 6.25% from my 9% size. The worst case scenario happened, and I got out with just a 1% ding to the portfolio, which is very easy to recover from. Next topic here now is let's move on to one of the most popular webinars that was done. This was on gaps. The date of this one, and I really encourage everybody to going back and seeing it, was the November 20th Lunch and Learn on gaps. Basically what I talked about and what gaps are is identifying an inflection point or a change in character on a stock. I broke all movements down on these inflection points to 5 different types, and you can have 15 outcomes from those 5 different types. So an extreme gap up or gap down is type number 1, and these will be very obvious when you look at a chart. A mild gap up or mild gap down moves a little bit away from the most recent price action, either to the upside or the downside, but it's not quite as pronounced as the extreme gap. A range expansion during earnings really sets a high and a low within the normal recent action. Algorithms are hitting stocks both to the upside and the downside, and that's why you see it. But what you want to look for is the next move above either the high or the low, and that's really the case with the gap ups or gaps down, whether it's extreme or mild. That gap day sets the tone and how you should be reacting going forward. You can have a bullish gap down. Hopefully you don't own the stock at the time, but very often this shakes out all the weak holders, puts in a bottom, and the stock takes off back to the upside. Same situation with gaps up. If you want to take a look at what happened to Shopify right now, this morning it gapped up 20%, set a high around 593 and has been pulling back ever since then. So that's in a situation where a gap up may not be healthy because you've given back 10% of that gain already. So really what we're looking for is to establish a high and a low of this inflection point and then reacting accordingly depending on what happens after that. I just got stopped out on Pinterest. It had a very nice gap up, didn't hold the low of the gap, broke the 200-day moving average, and I was out with my less than my 3% loss, 0.3% loss on the overall portfolio. Also understand that these types of gaps, they can resolve differently depending on what type of a market you're in. If you're in a bull, a bear, or neutral. If you're in a bear market, 99 times out of 100, a gap up is going to get sold. It's very rare that it's going to continue higher, and understanding what type of a market you're in is very important. Also understand that the gaps up and down are going to be impacted by the overall market, as I just said, but also moving averages and support and resistance over on the left side of the chart. Let's take a look at a couple of examples of gaps, and one that I'm fondly going to bring up is Tesla. And this is an example. Here's the daily chart of Tesla. It had been downtrending for a while under the 200-day moving average, but all that changed on October 24th when it had this big gap up on earnings. And plain and simple, this got this on my list. The next day when it moved above the daily high, again, we set a high and a low. We're in a bull market, which you can tell by this black line up here. This is talking about the trend of the overall market. And I bought in when we got back above, when we broke above the high of that day. Now what you want to look for is what happens when it pulls back to the 8 and the 21-day exponential moving average. Had some profits in here, locked a little bit of them in, still had a position when it gapped down on 1122. This was after the Cybertruck presentation, which was really initially not well received. But look at the action that happened along here. Let me set the chart back to 12/10/2019. And you can see it pulled back. I got stopped out when it broke below the 21, but it never really went further down from there, and then look what happened, got back above the 21. Look at how the last 2 days of the pullback were on lighter volume. Kept it on my watch list. Then this day, 12.9, it broke above this most recent range with volume off of the 21, and this was where I re-entered. And I don't think I have to tell you, if you follow the markets, what's been happening with Tesla since then. We've traded this very successfully, taking some profits along the way. Tim most recently took a nice exit here and bought back lower yesterday, doing very well with this stock in-house. This is an example of a gap up, an inflection point, changing what's going on with the market, changing the perception on Wall Street. Pension fund managers, hedge fund managers, individual investors all try to pile in because they realize that they've been on the wrong side, and this is what propels something higher. This is an extreme and very successful example, but you see this time after time again with these big volume gap ups. Let me bring in Pinterest now, which is something that I just recently did but didn't work. This was a very nice gap up, got above this resistance, but closed at the low of the day. Next day, it broke the low of the day, and I sold, and it hasn't really recovered since then, filling this gap. So they don't always work, but I'll take a 6%, 7% loss, which equals 0.2% on the overall portfolio. I'll take 5 of those if I can get one of those Teslas that is up over 100%. And it's just a matter of understanding familiar faces, what goes on with playing these gaps, and reacting accordingly. Final topic is going to be a review of the past 11 bear markets that I did. And what I've learned from this, which I knew, but it was nice to put some stats to it. The market does not get into serious trouble unless the S&P 500 breaks below the 200-day moving average. Let me bring in some stats that were generated by this. Let me blow this up a little bit. So, yeah, it doesn't need to be that big. So, what was learned from this exercise was that this was the 11 bear markets that happened going all the way back to 1968. Some of them, a 20% qualifies as a bear market. This is what happened of September to December 2018. It happened very quickly within 3 months, and leading stocks were significantly hit. But look, 20%, when you broke the 200-day moving average, we were out. This is well documented out on our website. You can listen to any of the videos about how we exited and how we got back in the beginning of January, because we've got rules for exiting and for entering. But some of these are very severe, down 37%, down 49% in 1974, down 36% in 1987, and then down 50% when the tech bubble burst, and down 58%. These are the S&P 500. The NASDAQ 100 was even worse when the tech bubble burst back in March or October 2002. But the point is that the average drawdown of these was 33% to the downside. Some statistics and a way to avoid the big losses is what I went through is a sell when the weekly close below the 40-week, which is the 200-day moving average. You get a weekly sell close 1 or more % below, you just exit with your long-term money. And then buy once you get a weekly close 1% or higher back above the 40-week or the 200-day moving average. And there were really some interesting results that came out of this. With the 11 bear markets, I mentioned the average drawdown is 33%. The high where the market was until the sell point was triggered. In other words, you got that close 1% or more below the 40-week moving average or the 200-day moving average. Your drawdown was 11.2%. That's pretty easy to handle. I can handle that. The average sell throughout those 11 saved you an additional 22.7% of pain to the downside before the market finally bottomed. And then when we got back and we re-entered, we were re-entering 9.4% below where we exited in the first place. This isn't the case for every bear market. Some of them you're buying back in higher. But if you're going to get an extreme bear market and you really never know which ones are going to be extreme, following these rules can really keep you out of a significant amount of trouble. And again, the key is always the 200-day moving average, which is the equivalent of the 40-week moving average on a weekly chart. And that is pretty much one other thing I want to, one set of statistics, and this is something that I developed when I was doing this, is I always keep very close track of what my beta is. Beta is basically how volatile your portfolio should be expected to move versus the overall market. And what you really want to do is put the odds in your favor when the market is healthy, and reduce your exposure as the market turns unhealthy. And this is a target that I try to achieve. If the market and all the indexes are trending nicely above their 21 EMA, I want to keep my beta at a minimum of 0.1, and if possible, I would be in some very strong growth stocks that might get it up to 1.5. Remember, growth stocks usually outperform the market by a factor of 2 to 3 when the market is trending very high. As long as you're still above the 50-day moving average, I don't want my beta to get less than 0.75. And on the upside, I want it to be a 1 if we're between the 21 and the 50-day moving average. If we start to break down, we break the 50, but we're still above the 100-day moving average, I want my beta to be around 0.5 to 0.75. I use beta. You can kind of think about this as your cash exposure point. If you're still above the 200-day moving average, reduce to 0.25 to 0.5. You break the 200-day moving average, this is when things really start to get dicey. You can actually, if a nice trend develops and you can't get back above the 200-day moving average, a negative beta, meaning you're using inverse ETFs to take advantage of the downside, can make you money in the market while everybody else that's buying and holding is losing money. And then if you're under the 200-day moving average, but you get what we call a follow-through day or a buy signal, this is what we documented on video back in early January of 2019. This is when you want to start kicking your beta back up. You're under the 200-day moving average, but now we're starting to get back above the shorter-term 21-day and the 50-day, so you can start ratcheting your beta back up so that all of the indexes, when they're configured correctly, you can take advantage of this beta being higher than 1, and then maybe as much as 1.5. If some people use margin, your beta can really get kicked up higher, but that's really only for experienced investors. And that is pretty much going to wrap it. And I would be glad now to take any kind of questions or chart requests. I see a couple of them typed in. Let's take a look at a few charts here. First one is Beyond Meat. This is something we own in-house, and this has been doing just one of the best looking consolidations that you'll see. It got a little ahead of itself after its IPO, really fell apart after they did a secondary offering in here. And this is an example of it. A hard break below the 21 tells you something. Holds at the 50, breaks below the 50, you really need to be out now. Heavy volumes break below the 50-day moving average, and then you watch what happens with the stock, because it is a good story. And you know, if people keep buying it, they've had a lot of successes, some failures too, but keep an eye on it. Now look, it tries to rally up. This is a classic bear rally. Fails at the 50-day moving average. Eventually the 50-day rolls over again, and it starts trending below the green line, which is the 21, the red line, which is the 50. But now, December, the market starts improving, it stops going down, still can't get back above the 21, and then all of a sudden here, early January 2020, big volume above the 21 and above the 50-day moving average. This makes me want to start looking at it again. Very strong rallies, went all the way from this 85 all the way up to 135, got a little ahead of itself, very similar to what you've seen in Tesla over the last 2 weeks. Pulls back, consolidates again, sets a low above this 100 area, one more shakeout below the 21, and now trending higher. Good volume patterns, has earnings coming up in 15 days. We own this in both of the growth portfolios that we run in-house here. Another request for Amazon. Amazon was an underperformer for a significant period of time. You'll look and see here how it could not get back above. I mean, it's one of the all-time winners, no doubt about it, but when do you want to own it and when don't you want to own it? They had some negative reactions to earnings. You can see here another earnings report where it rallied up into the 200, couldn't get back above it, and now here a change in character. Day after Christmas of 2019, I got into this because I learned from Netflix a couple years earlier, during a quiet period in the market like the holidays, if a big leader has big volume coming in, pay attention to it. It made not a lot of progress, but every time it pulled down near the 200-day moving average here, it found support. The market corrected a little bit toward the end of January, and then this big gap up on its earnings. Again, this is one that we own in both of our growth portfolios in-house here, and it's really been acting extremely well. Near at all-time highs now. Let's take a look at a weekly chart on it. 2200 all-time highs here on the left side of the chart. So it's broken above this 2100 level. This means that everybody that's ever bought Amazon and is still holding it is making money. You're not anxious to sell when you're making money. So Amazon looks fantastic. CMG, it's another one we own in-house here. CMG, this is a situation to where you buy a leading stock. We're constantly keeping our list of leaders, and when they pull back into an absolute low-risk entry point like this, bouncing off the 200-day moving average, we took a position in this in October off the 200-day moving average, and it's rewarded us very well. See it riding above the 21 here. Had earnings shake out below the 21, but where do you want it to find resistance? Right at the 50-day moving average, and that's exactly what it did. Beautiful bounce off there, now headed to all-time highs, CMG. Let's take a look at gold. Gold has been, usually when the market's up, gold is down, but gold has been consolidating very well as it is forming this cup and handle, pulling back, holding its 21-day exponential moving average. This is healthy, and it's also something that can cushion the volatility for your portfolio. When gold is acting well, I love to own it because normally it goes up on days when the markets are down, and that cushions your overall performance. CBLX, this is something that I talked about in the while all of the software stocks were correcting toward the end of last year, CBLX continued to act very well. This big gap up on earnings is another example of gaps in how something should act. Pulls back after the gap, makes a day two higher high, that's bullish. You got to be a little bit patient with these sometimes. Continues to make a higher high, pulls back, holds the 21. It's still a keeper as long as it's holding the 21-day exponential moving average. Then they pre-announce for their upcoming earnings report, big gap up. A pullback on this was actually where I took my initial position on this. Been rewarded with it. Nice recent move up. Ran into a little bit of resistance near the 100. Harsh pullback over the last couple of days, but it bottomed here at 89. You've got to give it a little bit of room. Notice the bottom here coincided with the recent highs over the last couple of weeks. So it found support exactly where you want it to, and now it's back in the upper part of its range on the day. If I don't want to let go of my longs, what is the best way, in your opinion, to lower my beta? Should I hedge? I'm hedged right now slightly with the NASDAQ 100. Why? Because I know from history that when the NASDAQ 100 gets over 7% extended from its 50-day moving average, it's difficult to go higher. So this is a situation, this is a tactical move. The other situation, if you don't want to, is you watch how the NASDAQ 100 and the key indexes act when they approach key moving averages like the 50-day and the 200-day. You break the 50-day and you don't want to let go of your longs because maybe there's tax consequences or because they're acting very well. You can hedge with inverse ETFs such as the QID, which is a two-time inverse ETF. Yes, this is a downtrending chart because it's going to be just the opposite of what's going on with the NASDAQ 100. And again, these are tactical moves. SDS is 2 times inverse of the S&P 500. Those are my 2 favorites to use as a hedge. Right now, the hedge I'm using is PSQ, expecting the NASDAQ to go sideways a little bit and cushion my equity curve. This could continue to go higher, but I'm really expecting it to go higher at a lower rate than the 50-day moving average catching up to it is going to. And again, I've got it sized appropriately so that it's not going to impact the portfolio. Really, this is just a tactical move. Next question, what is the best way to get over my insistence that the market can't go any higher? And it typically does without me. Paying attention to Tim's 3 ATR charts that he reviews on the videos and not buying something when it's extremely extended is a great way to keep from getting yourself in trouble. And what we do very often is buy the leading stocks on a pullback into the 21 or the 50-day moving average. So look for constructive pullbacks into moving averages and don't buy extended stocks is the best way to participate if the market's still going to go higher. Next question is, how do we find or calculate the expected move for earnings? This is something that it's in the options market, the way they price in on the earnings day. I'm going to ask Tim to do a video on this next time he does the videos, to mention this, go over it in a couple minutes, and he'll be able to explain to you what the expected move is for earnings. How do you time an exit in a stock like AMD, which just keeps grinding higher? Great question. AMD, I stopped out when it broke below the 21-day moving average. I had some nice gains. I rode this move the entire way up. It held the 21 the entire way up. Just got a little bit ahead of itself. Bounced off the 21-day moving average, announced earnings in it, and this is a situation where a gap down on earnings can be bullish, because what happened on the gap down day, it put in the low. It hasn't gone below the low of that day. I haven't gotten back into it. I would, but the way I manage money is I want to have a full position as long as something is below the 21. If it breaks below the 21, but it's still above the 50, I'll keep it down to a half position. In this case, I just decided to move the money into something that was acting a little bit better when it gapped down. I'm not going to get them right 100% of the time. This is a situation where if I'd have stayed in it, I would have made more money. But I think this money went into CBLX, which is doing just fine on its own. So something like this, AMD, it's one of the strongest stocks in the market. And again, you look for low risk entry points if you want to get into it. In this case, after it got above putting the low in earnings, it ran into the declining 21. I never like to see this, because these are people selling into the 21, but then it got back above the 21 here on 2-4, pulled back, broke below the 21. This was the final shakeout before its move higher. This would have been a great low risk entry point here. And AMD, one of the leading stocks in the market, continues to go higher. Last question that I have so far is, how do you overcome FOMO? By keeping your watch list. If you can't get over your fear of missing out, buy a very small percentage. If you're buying something that's extended, I guarantee you it's going to come back to the mean. It's going to come back to the 21. And a follow-up question to that, how do you know when a stock is overextended? To me, how far is it above its 21-day exponential moving average and its recent activity? You can see anything that's at all-time highs may or may not be extended. AMD, this has run up from 48 to 54, 10% in 3 days. That's a little bit extended. You can certainly expect a pullback. Wait till they come in to either the 80 EMA, take a partial position, 21 EMA, you can take a half position. They do come back. They always come back. They always revert back to the mean, and I'm talking about the mean as being the 21-day exponential moving average. Tim shows the same thing on his videos when he does his 3 ATRs. The 21 EMA is the mean there, and that's a perfect time to buy it. FOMO is just something that it's psychology, and you just really have to make a commitment to allowing price to dictate what you do and not your emotions. Last question, what dictates leadership of a stock, price or fundamentals? It's a combination. We key on the fundamentals, and really the fundamentals you're looking for, William O'Neill's acronym for leading stocks is CAN-SLIM. The N is something that I focus on, meaning a stock has something new. Either the stock has something new, there's new business conditions, or something like that. That is the best way to identify potential new leaders. And what you're going to find with these new leaders is that they're going to have either earnings growth, preferably both earnings growth and sales growth, but I will settle for sales growth. I'm okay if something is not making money as long as it has excellent sales growth. So now we've got the fundamentals in our corner. Then we're looking to the technicals to identify low risk entry points. Similar to the gaps that I talked about, or when I was doing the 13 rules, a high breakout from a base or a pullback into the 21 or 50-day moving average. Those are low risk entry points in fundamentally sound stocks, and that's how we run things here. One last one, and a chart is going to be ROKU. This is something I've owned in the past. Stopped out when it broke below its 50-day moving average over here. There's another situation where a bounce off the 200-day would have been a low risk entry point. This got down to within a couple percent of the 200. If it breaks the 200, you can stop yourself out. ROKU has earnings tomorrow. This is definitely something that's always on my watch list because of the story. They're monetizing. It's not just the device. They're monetizing advertising. When you broadcast over the big CBS, NBC, ABC, everybody's watching that commercial whether they want to or not. ROKU can tailor based on all of their data of who's watching what. They can tailor their advertising to just the target and just the target audience that anybody wants to advertise can. So it's not just the devices. It's the device, and it's also the advertising revenue that they're getting from companies that want to be able to target their advertising. So really, just the same way when you search for something on Google, any page you go to after that has an ad for whatever you went to. This is just the same thing for streaming video, same situation. So it's a great story. ROKU, I want to see how it reacts to earnings. Low risk entries for this. Again, I said I exited when it broke the 50-day moving average. Again, it rallied up, couldn't get through the 50. That's another sell signal. And then it starts rallying up into the 21. Bunch of sell signals here. Volume move off of the 200, back above the 21, now back above the 50. This is just running into the anticipation of earnings, but now we want to see what the reaction is to earnings. Note that they lose money even though their sales growth, 50% most recent quarter, 59% before. That's what I'm talking about by having the fundamentals in your pocket. They're losing a little bit of money, but their sales growth is astronomical. Eventually, good sales growth turns into earnings growth. So I'm going to keep an eye on what happens to this after it reports earnings. And it's 12:47, and that is going to wrap things up. As always, any feedback you want to give me, I want to hear it. I'm on Twitter at D Vandenbord, email don@revereasset.com, or by phone 855-REAL-WEALTH. Everybody, thank you for attending this 12th Lunch and Learn. Hope you took something away from it. I think the next Lunch and Learn topic is going to be on a routine for somebody that works full time. How you can participate in the market and also participate in growth stocks, but you're not able to watch the market all day. That's going to be the topic for the next Lunch and Learn. Thank you very much for attending, and everybody have an awesome day.